The Federal Reserve raised interest rates for the 9th time on March 22nd. This time it was just 0.25%, just a little bit. This brings the federal funds rate to 4.75 to around 5%, the highest it's been since 2006. Many are saying this is a positive sign, claiming this is an indication that the past rate hikes worked and we're near the end of this interest rate rally. But what does it really mean for you as an investor? Are speculations correct? Are we headed towards the good times again? Hi, this is Collin Plume, CEO of Noble Gold Investments. The most obvious effect on you is that you pay more to borrow while continuing to grapple with persistently high cost of living. Credit card annual percentage rates are now over 20% on average, up from 16.3% a year ago, according to Bank Rate. Home loans are expensive. The average rate for a 30-year fixed rate mortgage currently sits at 6.66%, up from 4.4% when the Fed started raising rates last March. And a lot of people got rates even lower than that, in the threes. As bad as that may sound, the Fed made it clear that some additional rate moves may be warranted. They may be is important, and it could indicate that even the Fed doesn't really know what they're going to do next. You know, you have these less than likely scenarios with all these rates moving. Consider the situation. Despite aggressive hikes last year and early this year, inflation remains elevated and the job market remains strong, supposedly. So the Fed has no choice but to continue raising interest rates. The danger is that each time a hike happens, we move one step closer to a recession. Then there are the layoffs at some of the largest, most established companies in the country: Amazon, Google, Facebook, many others. Add this to the continuous increase of grocery prices, and this can mean that the real effects of aggressive rate hikes are finally rearing their ugly head. This could spell worse times than expected, contracting economy with sky-high grocery prices on the heels of potentially unemployed Americans. Be careful of this glass is half full that a lot of experts have been talking about. The Fed rate hike means that borrowers will continue to see higher interest rates on mortgages, credit cards, and personal loans. However, some will claim that savers benefit from the boosted earnings on their balances. While saving rates are considered high at, let's say, 1%, and let's say inflation's at 6%, you're not beating inflation. Inflation is winning. It's always winning, and it always keeps you away from growing your wealth. Don't count on better days coming to save to you. You have to put matters into your own hands. Hedge and protect your wealth, protect your investments, and protect your future. Gold has proven to be the best performing asset during and after economic downturns. In fact, it was the best performing of all the major assets in 2022. Now, that's saying a lot for a year when almost everything happened under the sun and all these different financial collapses. So let's look at gold now. Take a look and invest in gold now.